Good morning, miss. My topic for today's assignment is Models for Determining Cash Optimal Needs. Introduction. Cash performs vital role in the business. Cash is termed as a basic component to satisfy not only the day-to-day requirements of business but also making payments to creditors. That is why maintaining adequate cash balance is an important task in cash management. The following points highlight the top two cash management models. They are the Baumol's EOQ model of cash management and Miller-Orr cash management model. Baumol's EOQ model of cash management. This is the introduction of Baumol's EOQ model of cash management. William J. Baumol suggested that cash may be managed in the same way as any other inventory, and that the inventory model could reasonably reflect the cost-volume relationships as well as the cash flows. In this way, the economic order quantity EOQ model of inventory management could be applied to cash management. It provides a useful conceptual foundation for the cash management problem. This is the diagram of Baumol's EOQ model. You can see total cost there, holding costs, and the transaction costs. In this model, the carrying cost of holding cash, namely the interest foregone on marketable securities, is balanced against the fixed cost of transferring marketable securities to cash or vice versa. The Baumol model finds a correct balance by combining holding cost and transaction cost so as to minimize the total cost of holding cash. The optimum level of cash balance is found to be, this is the formula of the Baumol's EOQ model. C is equal to root of 280 divided by I, where C stands for optimum level of cash balance, A stands for annual cash payments estimated, T stands for cost per transaction of purchase or sale of marketable securities, and I stands for interest on marketable securities per annum, that is the carrying cost per rupee of cash. Let's go back here. According to the model, optimum cash level is that level of cash where the carrying costs and transaction costs are the minimum. The carrying cost refers to the cost of holding cash, that is interest foregone on marketable securities. The transaction cost refers to the cost involved in getting the marketable securities converted into cash and vice versa. Assumptions. The Baumol's model holds good if the following assumptions are fulfilled. First one, the rate of cash usage is constant and known with certainty. The model has limited use in times of uncertainty and firms whose cash flows are discontinuous or bumpy. The second one, the surplus cash is invested into marketable securities, and those securities are again disposed of to convert them again into cash. Such purchase and sale transactions involve certain costs like brokerage, registration, clerical, and other costs. The cost to be incurred for each such transaction is assumed to be fixed or constant. In practice, it would be difficult to calculate the exact transaction cost. The third point, by holding cash balance, the firm would incur the opportunity cost of interest foregone by not investing in marketable securities. Such holding cost per annum is assumed to be constant or fixed. The fourth point, the short-term marketable securities can be freely bought and sold. Existence of free market for marketable securities is a prerequisite of the Baumol model. Limitations. The important limitations in Baumol's model are as follows. The first one, the model can be applied only when the payments position can be reasonably assessed. The second one, degree of uncertainty is high in predicting the cash flow transactions. The third one, the model merely suggests only the optimal balance under a set of assumptions, but in actual situation it may not hold good. Nevertheless, it does offer a conceptual framework and can be used with caution as a benchmark. Let's move on with the first problem, and this is the first illustration. And the question says, the outgoings of Gemini Limited are estimated to be rupees 5 lakhs per annum, spread evenly throughout the year. The money on deposit earns 12% per annum, more than money in a current account. The switching cost per transaction is rupees 150. Calculate the optimum amount to be transferred. The formula is C is equal to root of 2AT divided by I, where C stands for the optimum transaction size and A is the estimate cash outgoings per annum, that is rupees 5 lakhs. T is cost per transaction, that is rupees 150. I is the interest rate on fixed deposit, that is 12% per annum, which will become 0.12. So it will be C is equal to root of 2AT divided by I. Then it will be C is equal to the form below the solution. I have included the image there. Then that is C is equal to 2 into 150 into 5 lakhs divided by the percentage, that is 0.12, and the amount comes to rupees 35,355. Let's round it up to say rupees 35,000. The number of transactions per annum is rupees 5 lakhs, which is to be divided by rupees 35,000. The estimate cash outgoings per annum, that is rupees 5 lakhs, is to be divided by the optimum transaction size, which we have got as rupees 35 lakhs. The amount is 14 transactions, and the average balance in the short notice account is rupees 35,000 divided by 2, which comes to rupees 17,500. Then we have the aggregate of fixed costs, which is 14 transactions into rupees 150, which is the cost per transaction, which comes to rupees 2,100. The second problem that we have is ABC Limited has estimated that use of rupees 24 lakhs of cash during the next budgeted year. It intends to hold cash in a commercial bank which pays interest at the rate of 10% per annum. For each withdrawal, the company incurs expenditure of rupees 150. What is the optimal size for each withdrawal? Okay, the solution to this will be again the same formula. C is equal to root of 280 divided by I. and then it will be C is equal to 2 into 150. That is the expenditure which is given in the problem. Then it is 24 lakhs, which is the cash, estimated cash, which is to be used during the next budgeted year, divided by the percentage, that is 10% per annum, which becomes 0.10. After calculating this, we get rupees 84,853, rounded up to 85,000. The second model that we are moving on to is the Miller-Orr cash management model. This is the introduction of the model. The model asserts that transfer money into or out of the account to return the balance to a predetermined normal point whenever the actual balance went outside a lower or upper limit. This is the diagram of the model, and the model specifies the following control limits. H stands for the upper control limit, which is beyond the cash balance, should not be carried. O stands for the lower control limit, that sets the lower limit of cash balance, that is, the firm should maintain cash resources at least to the extent of lower limit. And Z stands for the return point for cash balance. The assumptions to this model are: the major assumption with the model is that there is no underlying trend in cash balance over time. The second one is the optimal values of H and Z depends not only on the opportunity cost but also on the degree of likely fluctuations in cash balances. The model can be used in times of uncertainty and random cash flows. This model is based on the principle that control limits can be set which when reached trigger of a transaction. The control limits are based on the day-to-day variability in cash flows and the fixed cost of buying and selling government securities. Let's move on to the first problem, that is the lower control limit set is rupees 1000. The interest rate per day is 0.025%. The standard deviation of daily cash flows, variance of rupees 2,50,000 is rupees 500, and switching cost per transaction is rupees 20. Let's move on to the solution. The image that I have inserted should come on top, that is, the spread should be calculated first, and that is the formula. 3 outside and opening the bracket, 3/4 into transaction cost into variance of cash flows divided by the interest rate, closing the bracket. By taking the upper limit and the spread in the lower limit, we are supposed to calculate this. So that is 3/4 into 20 into 2,50,000 divided by the percentage, 0.025. That will be here. So the upper limit is the spread plus lower limit, that is 7,400 plus 1,000, which comes to rupees 8,400. The return point is equal to the lower limit plus 1/3 into spread, that is 1,000 plus 1/3 into 7,400, that is 1,000 plus 2,467, which comes to rupees 3,467. Let's move on to the second illustration. The second illustration under this model is: a company has a policy of maintaining a minimum cash balance of rupees 1 lakh. The standard deviation in daily cash balances is rupees 10,000. The interest rate on a daily basis is 0.01%. The transaction cost for each sale or purchase of securities is rupees 50. Compute the upper control limit and the return point as per the Miller-Orr model. Here is the solution. Same, you have to use the formula. You're supposed to put the numbers under the formula and then evaluate them. That is 3 and open the bracket, 3/4 into 50 into 10,000 raised to 2 divided by 0.001 raised to 1/3 the whole bracket. Thus the upper control limit, the amount after calculation will come to rupees 1,04,15. Thus the upper control limit of cash balance is rupees 1 lakh plus rupees 1,04,15, and the total amount comes to rupees 2,04,15. To calculate the return point, you are supposed to take the lower limit plus the spread divided by 3, that is 1 lakh plus 1,04,15 divided by 3. The total comes to rupees 1,33,472. Now in this both problems you can see the word spread used there. I'll give a little introduction on that spread. Spread between the control limits. The higher the variability in cash flows and transaction cost, the wider and higher the control limits will be. Conversely, the higher the interest rate, the lower and closer they will become. Within the control limits, the cash balance fluctuates unpredictably. When it hits an upper or lower limit, action is taken by buying or selling securities to restore the balance to its normal level within the control points. In applying the model, one must set the lower limit for the cash balance. This could be 0 or some minimum safety margin above 0. And that's it. Thank you. That's it. I have covered 2 models in this, that is the Baumol's EOQ model, and the second model that I have taken is the Miller-Orr model. Both of these are the cash management models, and I hope I have explained good enough so that ma'am you were able to understand. That's it. Thank you and have a good day ahead.